Hey guys, Toby Mathis here with Anderson Business Advisors, and today we're going to talk about how to pay zero taxes in 10 minutes or less. All right, let's dive on in. Number one, in order to understand how to pay less tax, you got to understand how taxes actually work. And my experience is that 99.9% of the people out there have no flipping clue, and that includes a lot of the tax practitioners, unfortunately. And here's where we're going to start. We're going to do the 10,000 foot view. Now we're going to be specifically drilling into capital gains in this particular video, although there's lots of others. You can look on YouTube. You're going to see that we have a lot of content on my channel that'll show you how to eliminate tax. But you have to understand how all the taxes interrelate. And so I'm going to focus on the different types of taxes. There's actually three types only. Anybody starts telling you differently, it's because they just don't know. There's three broad overlying factions of these. So number one, I'm just going to call it active. And we'll just say active income. Number two, and this active income, it's the worst possible tax treatment you can receive. Active income is subject to, and I'm going to put it in red, ordinary rates plus Social Security. Here's how bad this is. Of all the taxes we collect every year in the United States, of all the taxes we collect, that's income, old age, disability survivors, Medicare, all that good stuff, estate taxes, corporate taxes, this accounts for a little bit over 88%. You work at McDonald's, and somebody's going to run around and say, you don't pay any income taxes. That's a lie. That's a lie that's been repeated so often that people actually believe it. You're not paying the income tax, the federal income tax at the ordinary rates, but you're definitely paying that 15.3%. The employer pays half, you pay half on old age, disability, survivors insurance, and Medicare. If you're self-employed, hey, I'm a little guy that's running a plumbing company, and you say, oh, your taxes were so low, you had a standard deduction, you barely paid any tax at all. Complete fabrication. You're paying self-employment tax. Same thing. That Social Security is also called self-employment tax. Same thing. You're paying 15.3%. You make $100,000, over $14,000 is going to leave your pocket going to just that little guy. And what's sad is this is really the only place that exists. So it is the worst possible treatment. When I worked for McDonald's, I was 16, I was making $4 an hour. I was paying this tax. They would withhold from me and I'd get a refund on my federal taxes because I didn't make above the standard deduction, or I was in a super low, uber low bracket, like 10%, and they were withholding over 20. So I'd get some refund and I'd be like, yay, I got some refund. Make no bones about it. We're paying, if you're getting a wage, if you're getting a salary, you're paying taxes, period. They lie about that all the time. Number two is portfolio. In portfolio income, there's several types that I'll go into, but what's most important is there's no Social Security tax. There's a way, if you screw up or you do something that becomes your business, to turn portfolio income into active income. But for my topic today, I'm not going to dive into those weeds. I'm just going to say, as a general practical matter, this is royalties. Like, hey, I wrote a book, or I have software out there, I'm getting a royalty. It's going to be taxed as ordinary income, but no Social Security tax. I have interest. Hey, I loaned money to my buddy, or I'm loaning money to somebody, and they're paying me back that interest. That's taxed. No Social Security tax. It is subject to ordinary tax. And then we get into some cool ones. Dividends. So dividends equal a tax treatment called long-term capital gains. And this is why that's important. These are taxed at 0, 15, or 20%. long-term capital gains rates, which means they're treated preferably. And again, no Social Security. Hold on for a second. What's a dividend? If you own securities, like, hey, I own a piece of, let's say, Apple. I buy some stock in Apple, and they pay me a dividend every year. Or Procter & Gamble, or 3M, or Coca-Cola, or Chevron, or Verizon, or AT&T, right? All these companies pay dividends out to their shareholders because you're a shareholder. They're sharing the profit with you. That could be taxed at zero. Like, again, if I was at McDonald's, working at McDonald's, I'm up here, I'm paying Social Security, and I'm paying ordinary tax rates, that stinks. But if I have dividends coming in, I'm smart enough and I start accumulating a portfolio, zero. I'm not going to be paying tax on that. If I make a whole bunch of money, like, oh, I'm getting $100,000, $200,000, $300,000 a year, I might pay 15%. You make $10 million a year and you have dividends, it's taxed at 20%. Now, there's a net investment income tax that raises it to 23.8. If you hear anybody say 23.8, it's because they're adding in the surcharge. But that's pretty darn potent. And then you have capital gains. And the long term, I just told you, if you hold something over a year, or if you do futures, 60% of it's treated as long term. It's that long term. If it's short term, all of these, this one, this one, this one, they're all ordinary. They're all added up into your ordinary bracket. Now, why is this important? These little guys down here, capital gains get offset by capital losses only. Capital gains get offset by capital losses, or better yet, capital losses only offset capital gains, except that if I have excess capital losses, so let's say I lose money on a security, so I buy stock du jour and I lose $10,000. I'm limited to use that $10,000 against other capital gains, but I could take $3,000, let's see if I can put up the right numbers, $3,000 a year against my active ordinary income or other income sources. So it's actually pretty potent when you start looking at these things to how do I eliminate capital gains? One of the first ways you eliminate capital gains is by generating capital losses on other capital assets. So for example, I have a whole bunch of stock gain. Great. Watch, but I have Bitcoin too. Sell your Bitcoin when it goes down that 30%. It does this, like Bitcoin's like, it goes up 30, down 30, all over the place. When it goes down, just sell it. Great. Buy it right back. Now I have a capital loss, but I own Bitcoin still. I could take that loss and offset my gain. That's number one. Number two is don't sell things. If you have a capital asset, you can borrow against it. So there's something called a security-backed line of credit. They call it bank on me nowadays. They're talking about all the ultra wealthy, like, Elon Musk, he's got billions of dollars of stock, right? He doesn't pay any taxes. Why? Because he doesn't sell his stock. He borrows against it. Hey, give me a loan. I won't default, but if I do, you can take some of my stock, right? I got billions of dollars of stock, so give me a few $1 million of line of credit. You don't pay tax on that. If you have real estate, you have 1031 exchanges. Hey, I don't have to pay tax. I just keep buying more. 1031 exchange. Or I'll take any capital gain and I can invest it in a qualified opportunity zone and I could defer it. Like there's lots of different ways to not pay any tax once you understand where it sits. Now you notice I said there was 3 types of income. So here's the third, and it's called passive. Passive income. Passive income, there's only 2 types. It's really simple. The 2 types, number 1, rents. Rents are always considered passive unless it's not rents. So for example, like if you're doing an Airbnb and it's 7 days or less average tenancy, the regs say that's not rents. But if it's rents, it's passive, period. It ends up being really cool because passive income, again, is ordinary, but no Social Security. Hopefully you guys can see that. No Social Security. So it's really, really all of these down here, you start realizing, wait a second, if I don't want to pay a lot of tax, maybe I should be making tax, or maybe I should be making my income here and here. Duh. The wealthiest people making over $1 million a year, guess where up to 96% of their income comes from? 2 and 3. Less than half on average comes from 1, because it's the worst tax treatment. But so I said there was 2 types of passive income. The second is businesses in which there's no material participation. So I'll just say businesses silent. I won't give you the technical rollout, but it's businesses that you do not materially participate in. It just means you're a silent partner in a business. You don't do anything in the business. So immediately you start thinking of rich Uncle Ned or whoever it is, rich Aunt Sally, and hey, they're always investing in businesses, but they don't want to be any part of it. It's because they probably have a whole bunch of rents coming in, and they're thinking, how do I not pay tax on the rents? I'll go into these passive investments and startups, and I'll generate a bunch of loss in the first year or 2 years, and it will keep me from having to pay tax on this. The other thing they do is they say, hey, if I have rents, I have huge depreciation. I have all sorts of tricks up my sleeve. I can accelerate my depreciation. I can use bonus depreciation. I could do cost segregation. I could do a lot of fun stuff, or I could borrow against the asset, not pay any tax. I have all these tricks in my tool bag. Hey, I got 1031 exchanges. I got to step up in basis when I die so nobody ever pays tax on it. Like I have all these little tricks floating around up here. If you pay tax on rents, because you're not trying hard enough to not pay tax on your rents. There's always a way to not pay tax on rents. So we start looking at this, our 3 types of income, and immediately we realize that, boy, they're treated so differently. They're treated so differently. Why are not more people going into this? Well, the 2 best tax treatments, capital gains, long-term capital gains specifically, and in rents, there's a little nuance, which is they limit the losses against that same type of income. So for example, on the passive, that's a little bubble. They can only offset each other with very few exceptions. So if I have a whole bunch of losses that I generate on my rents, I can offset other income that's coming in off of my silent business ownership. But what I can't do is take all that loss and use it against my active income, unless there's a couple ways to do it, real estate professional and active participant. But for the most part, normal people, you're just going to be stuck there. You don't lose it, you just carry it forward and it keeps offsetting that income, which is why the wealthiest people tend to get stuck in that bubble, and they're always doing that. Like, hey, I don't want to participate. Hey, I don't want to do this. I just want to buy and I want to rent. So, hey, I want to open up a business. Will you give me a bunch of money? And they might be like, well, hold on for a second. I might buy the real estate. I'll rent it to you. I'll give you a really good rent rate. I'll defer the rent for a while. All those things, they'll do that because they know it fits in with their tax planning. And they're going to get a huge benefit. They're in the highest tax bracket. So every dollar of deduction is worth over 37 cents to them. In some cases, over 50 cents to them. So they may just be glad, hey, I'm putting my cash out there to play, and it's going to save me a whole bunch of money. I know I just threw a lot at you. There's a lot of content on this channel. Please subscribe, like us, and if you like this type of information, please share it.